This is Nightly Business Report with Bill Griffith and Sue Herrera.
Washington worries. The weeks-long partial federal government shutdown is starting to create anxiety on Wall Street and nervousness among investors.
Business at risk. It's not just Wall Street. Main Street business owners that rely on the government are now getting creative to stay afloat.
Not so happy returns. The high cost of bringing all of that unwanted holiday merchandise back to stores. Those stories and much more tonight on Nightly Business Report for this Friday, January the 11th.
Good evening, everyone, and welcome. The partial government shutdown is on track to be the longest in history. President Trump and Congress appear no closer to a deal to reopen the parts of the government that are closed. The reality is hitting federal workers who today missed their first paychecks. And there are new estimates as to the broader economic cost. So far, the economy has lost about $3.5 billion. According to S&P Global Ratings, it will only take another 2 weeks for the shutdown to exceed the amount of money the president wants to fund a border wall. And on Wall Street, analysts are starting to take note as well of the potential impact to a number of sectors. Bob Pisani starts us off tonight.
The government's now been closed for 21 days. That ties the record for a standoff set in 1995-96 between Bill Clinton and House Speaker Newt Gingrich.
Giving up on balancing the budget, I think, would be a tragedy that would haunt us for the rest of our lives.
It is wrong for the Congress to shut the government down.
And while investors might have shrugged off shutdown concerns early on, Wall Street's starting to get a little worried here. We're seeing a rash of analyst notes warning that this will soon start to affect different businesses. So some warned about the effect of the shutdown on airlines and the business of travel. American Airlines, for instance, has significant exposure with its hub in Washington, D.C. Others worry about tax refund delays and what the shutdown will mean for stores that cater to lower-income consumers. They say prolonged government shutdowns jeopardize food stamps and other benefits that low-income customers rely on. That could prove to be a big headwind for retailers that cater to those lower-income customers. Defense contractors who work with agencies like NASA and the State Department could also be disrupted, and they could lose revenue if they halt projects altogether. Still, others are worried about the longer-term impact on infrastructure projects and federal cybersecurity workers, for example. This is not just theoretical. Some damage has already been done. J.P. Morgan has already lowered its first quarter GDP growth estimates to 2%, primarily because of the government shutdown. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
There was some movement in Washington regarding the shutdown today. The House voted to restore funding for some federal agencies that have been furloughed, including the Interior Department and the Environmental Protection Agency. But Senate Republican leader Mitch McConnell said he would not bring that bill up for a vote since the president would not be expected to sign it. Separately, though, the House voted to ensure that all federal employees will be paid retroactively after the shutdown ends. The Senate approved that bill unanimously, and the president is expected to sign it.
Meantime, the Federal Reserve and several banking agencies have asked financial firms to work with those affected by the partial shutdown. Banks are being urged to consider things like loan modifications or extending credit. This is the type of guidance that is normally issued following things like hurricanes and wildfires or other natural disasters.
The shutdown is forcing Miami International Airport to close one of its terminals over this weekend because security screeners have been calling in at twice the normal rate. Calling in sick, that is. Miami is the second busiest international airport in the country after New York's JFK. And officials say they are just concerned there will not be enough workers to handle all 11 checkpoints during normal operating hours on Saturday and Sunday. As you know, today marked the first day that TSA screeners missed a paycheck.
The 800,000 federal workers who aren't getting paid are the first to feel the impact, but the effects are quickly rippling through the economy. And now some small business owners are worried that they're getting pinched. Kate Rogers has our story.
Kimberly Stewart runs Stepping Stone Consulting in Northern Virginia, a three-person company doing both contract work for the government and small business consulting. Federal contracts make up about 1/3 of her business, and due to the shutdown, her company's been notified to stop work on a project with the Department of Transportation, a first for Stewart, who says she's worked through previous shutdowns.
It's more than 800,000 federal employees that are being impacted. It's the small businesses that are really, truly at risk of going out of business.
Stewart planned ahead for a potential government closure with cash reserves and is shifting her focus to consulting work to make up some of the revenue she's missing out on during this shutdown. But she says her business is jeopardized the longer this drags on.
Having the shutdown go on for such a long time, it really does put my business at risk. It is a third of my revenue right now, and I did build up a reserve, but I'm eating that reserve at this point.
Meanwhile, in Houston, Texas, Helen Callier says she's without an important resource, the Small Business Administration. Her company, Bradlink, is also a government contractor. While she's able to continue her contract work, she's unable to work with the SBA's 8A program on business development during the shutdown to attempt to gain work on future contracts.
The challenge that we have is that key folks that we need to leverage to go after contracts in that program, they are not working. That's an impact, and we're being real creative to see how we can still make something happen.
Both business owners urge leaders in Washington to come to an agreement to end the pain for federal workers, contractors, and small businesses across the country. For Nightly Business Report, I'm Kate Rogers.
Farmers around the country have now been hit with a 1-2 punch. They are being indirectly affected by the partial government shutdown while they continue to deal with the fallout from the trade war with China. Aditi Roy has our story from Denair, California tonight.
It's a busy time at Monte Vista Farming in Stanislaus County, California. Workers are sorting more almonds than usual because the farm grew a bumper crop this year.
So we've got this massive volume, and our processing plant and our marketing has been conditioned for so many years on having China as sort of a pressure relief valve on our inventory.
But CEO Jonathan Huff says this year, the farm's shipments to China, which usually account for 9% of total exports, have sunk because of the country's 50% tariffs on the nuts.
Well, in a normal year, we wouldn't have this many finished goods stacked up here.
The almonds are piling up, and Huff's looking for other markets where he can ship them. To make matters worse, government aid payments to farmers affected by the tariffs are delayed because of the shutdown. Farm Service Agency offices around the country are also closed, which means farmers can't process their aid applications or government checks. Huff says the prices he's getting for almonds has dropped 20%, even though consumer prices are about the same.
You know, we've been resilient. We've been able to get through it. Market prices have come back to a certain extent. But we definitely want to see this trade situation resolved in the near future.
Across the country, dairy and grain farmers are also struggling with what Huff calls the 1-2 punch of the tariffs and the shutdown. One effect, 3 critical USDA crop reports have been delayed because of the shutdown. Those reports show the demand for corn, wheat, and soybeans, and how much crop was produced last year. That data helps traders set prices and farmers make planting decisions.
All of this crop still has to be processed, packed, and shipped to some market before 2019 crop.
As Huff worries about running out of warehouse space for his excess almonds, he remains hopeful about the future.
You know, there's this sort of notion that we're going to endure some short-term pain for long-term gain. As long as that's the direction that we go in, then we're okay.
President Trump is scheduled to address farmers at the American Farm Bureau Convention in New Orleans on Monday. For Nightly Business Report, I'm Aditi Roy, Denair, California.
On Wall Street, stocks snapped their 5-day win streak. The indexes were pushed marginally lower on concerns about the shutdown and that slowing growth in China. The Dow Jones Industrial Average fell about 6 points to 23,995. The Nasdaq was down 14 and the S&P 500 fell a fraction. For the week, though, the major averages all showed solid gains. Meantime, oil prices broke a 9-day win streak, which was the longest string of gains in 9 years. Domestic crude settled down nearly 2%.
And after a run of disappointing earnings reports, General Motors has finally bucked that trend. The automaker said today it expects to beat its earnings projections for 2018. It also gave an upbeat outlook for this year. And that's easing some concern about demand slowing here in the U.S. and in China. And it was enough to send the stock up about 7% today, closed at $37.18. Phil LeBeau has more details for us.
For all the hand-wringing about auto sales slowing down around the world, General Motors says business remains solid. In fact, it's raising its earnings expectations due to strong demand for high-profit vehicles like the Chevy Silverado.
From an 18 perspective, again, it was not only a focus on really, capitalizing on the new trucks that we have out there, the light-duty trucks, but also the focus on cost reduction. So it was across the board, every element of the company.
The cost reductions behind GM's bullish outlook come from the money saved by shutting 6 plants in North America and eliminating roughly 15,000 jobs.
That's a huge contribution to 2019. I think this is what investors have been underestimated. It's also the contribution from their new trucks, the full-size pickups, which are rolling out in dealerships as we speak.
GM is also planning to roll out an all-electric Cadillac to make the luxury brand its flagship for electric vehicles. And it still plans to launch an autonomous rideshare service through its subsidiary, Cruise, though when that will happen remains unclear, as does the question of what it will take to get investors excited about GM. It's been 5 years since Mary Barra became CEO, and while she has raised profits for the automaker, the stock has done very little during her tenure.
We have much more work to do. Clearly, we come in and work and focus every day on creating shareholder value and making sure that we're providing a sustainable General Motors for the long term. We have much more work to do, so we've made progress, but my focus is on the work we still have in front of us.
But are you satisfied with your performance?
I'm never satisfied.
GM is not the only auto stock that is stuck in neutral. Most of the sector has struggled in the last year. But General Motors is hoping its optimistic view of 2019 will reverse the fortunes of its stock. For Nightly Business Report, I'm Phil LeBeau.
It is time to take a look at some of today's upgrades and downgrades. Starbucks was downgraded to neutral from buy at Goldman Sachs. The analyst cites concerns in China and says Starbucks will be the next U.S. brand to warn of weakness in that country. The price target is $68. Starbucks fell a fraction to $63.73. Goldman Sachs also cut its rating on Yum Brands to sell from neutral. The analyst cites concerns about U.S. sales momentum at Pizza Hut and Taco Bell. The price target is $76. The stock fell nearly 1% to $90.94.
The Gap was downgraded to underweight from overweight at Barclays. The analyst there cited challenging traffic trends and difficult comparisons. Price target $25. That stock lost a penny today to $25.24. And Netflix was upgraded to strong buy from outperform at Raymond James, with the analyst citing a solid content slate of programs which could help drive revenue and earnings per share even higher. Price target $450, and shares rose about 4% today to $337.59. The stock has gained 37% just since Christmas Eve.
Still ahead, the world's biggest banks report their earnings next week, and they carry a lot of weight in the market. But what are the odds that they'll have a blowout quarter?
Here they come. Bank earnings will be in focus next week. Citi will be the first to report its results on Monday. Then you have J.P. Morgan and Wells Fargo on Tuesday. Wednesday and Thursday, we will hear from Bank of America, Goldman Sachs, and Morgan Stanley. David Dietz is with us tonight. He's President, Chief Investment Strategist at Point View Wealth Management. First of all, big picture. I mean, interest rates have remained low. The housing market's not setting anybody on fire. Trading revenue might be a problem. Investment banking. What are your expectations overall?
Well, overall, we have mediocre fundamentals for the banks. And the problem is the economy outlook has deteriorated just a little bit as people are focused on concerns like trade, like the government shutdown. And at the same time, of course, interest rates are so important to the banks. The net interest margin, the difference between what they pay to get a deposit and what they lend it out at, that has shrunk as the yield curve has flattened. So the fundamentals are a little weaker. The positive, though, is that with bank stocks down roughly 20% from their January highs, we think there's over-pessimism in the group, and therefore money can be made this year if things stabilize.
You know, it's also, we can kind of divide it up into those banks that are domestically centered and those that have an international presence. I would think the international banks will also give us an idea of how the global economy is doing.
You are so right, Sue. Citigroup is going to be the one that I'm watching for. We're going to hear from them on Monday, and more than half their business is overseas. So we're going to get great insight, not only as to what's going on here, of course, but what's going on overseas.
And among the domestic banks, Bank of America is the one you're watching the most closely, right?
I think Bank of America is your ultimate bellwether. Why is primarily domestic. Second, they're not affected by any scandals. Of course, the Federal Reserve has capped the amount of growth that Wells Fargo can experience. You got some of the investment banks like Goldman Sachs under pressure from their lawsuit in Malaysia. Bank of America is pretty clean there. They're on every corner. So they're going to give you a great read as to the health of the domestic economy.
You know, the Fed this week, there was a lot of, I wouldn't say controversy, but there was a lot of talk from various Fed members about the course of interest rates, the course of the economy, should they keep raising rates? And you brought up the interest rate differential earlier. If the Fed does not continue to move on its projected rate increase, what impact is that going to have on the banks?
Well, I think it's going to be a positive impact because I think you're going to see some steepening of the yield curve. I think people are going to pile into the short end of the yield curve and push short-term rates down. That's going to reduce the amount that banks have to pay for deposits. At the same time, as people get more confidence with what's going on with the Fed and the economy, I think there'll be greater loan demand. That'll push interest rates up. The spread will be better, and you'll see that reflect in bank earnings.
Well, definitely next week should be very instructive, that's for sure. David Dietz with Point Wealth Management. Always good to see you. Thanks.
Thank you, Bill.
See you later.
A well-known investor is rolling the dice on Caesars Entertainment. That's where we begin tonight's market focus. Billionaire investor Carl Icahn has reportedly built a position in that casino operator. As first reported by CNBC, the size of the stake was not immediately known. Caesars, as you may recall, rejected a merger approach last year by the owner of the Golden Nugget casinos. Shares of Caesars popped 9% to $8.71. Activision Blizzard is cutting ties with the video game studio behind one of its biggest hits. The surprise move came last night and raises questions about the strength of the company's games for 2019. It is unclear why the two parties terminated their 10-year contract. Activision Blizzard shares fell more than 9% to $46.54. And Vail Resorts lowered its profit forecast. The company said guest visits to its mountain resorts were much lower than anticipated in the pre-holiday period. Vail says its properties in Whistler and Lake Tahoe in particular suffered from weather-related issues. Shares plunged nearly 13% to $187.33.
Meantime, Chico's plans to close 250 stores over the next 3 years as part of a planned digital expansion. The retailer says it has invested in technology to improve its online offerings and customer service. Chico's also raised its fourth quarter sales forecast, by the way. Shares rose by 4% to $6.18 today. And a private equity firm says it has no plans to sell its stake in Canadian medical cannabis company Tilray. Privateer Holdings will instead hold on to those shares until at least the second half of this year. So far, Privateer has limited its investments in the cannabis industry to Tilray, which it believes has a good long-term global growth strategy. Tilray shares, which have been volatile, if you follow them, they soared by 19% today to $96 even. And after the bell, cooler maker Yeti reported stronger quarterly sales thanks to solid demand for its drinkware and outdoor products. The company also raised its guidance for the full year, and that initially sent the stock higher in the extended hours session. Shares finished the regular day up more than 2% to $16.72.
It is time for our weekly market monitor who likes the small cap stocks. He says the extreme market volatility has created the most mispriced stocks he's seen in a decade. Joining us is Craig Hodges, CEO of Hodges Capital Management. Welcome back, Craig. Great to see you.
Thank you, Sue. Nice to be here.
When I was reading through the notes, you really do mean there's a lot of mispricing, in your opinion, in these stocks. So let's start with commercial metals. This is what you say is the most mispriced stock in the market today. Why?
Yeah, it's really, the company is hitting on all cylinders, probably having as much success as the company has ever had. At Hodges Capital, we followed the stock for at least 25 years. The stock's trading around $15. In 2007, they earned about $2.90 a share. The stock traded as high as almost $40. So almost the same earnings, and the stock's 70% lower. This is a company, it's a rebar manufacturer. They've got about over a 50%. They just made an acquisition that's going to make them a 50% player in the U.S. rebar market. Earnings are going up. This acquisition they've made is very, very accretive. I think even the company's baffled why the stock is trading like it is. So I think this is one of the most mispriced stocks I've seen in a long, long time.
You also like At Home, the home decor company. But as we've mentioned, I mean, this company has suffered along with the home builders and others involved in the housing market. So is this a bet that the housing market recovers or not?
Not really. This is a kind of a home decor superstore concept. Only have about 115, 120 stores. They're going to grow that to over 600. So it should easily grow 20, 25% over the next 5 years or so, but only trading about a 20 multiple. So that's a good risk-reward ratio. They're going to go into the hotter markets. They're very, very popular with the millennials. A good growth concept that I think has been also a stock down about, that's been cut in half, here in the last 4 or 5 months. So it's a good entry point on a good growth company where you're not paying crazy multiples.
And finally, Helmerich and Payne, I was really impressed with the dividend, 5.3%. Yeah. And you say they have consistently paid and raised the dividend for more than 45 years.
Yeah, one of the highest quality companies we know of at Hodges Capital have owned this stock for years. The energy markets, and they do land drilling services. They have flex rigs. They're the most efficient rigs out there, land rigs. But, here's a company that has consistently performed in a very volatile business. And it is still volatile, but they've been able to ride out the storm. So like you mentioned, Sue, the 5.3% dividend, I think, is very, very safe. And the stock's also down about 30% just in the last 3 months. So another, I think, a real opportunity out there.
Craig, thank you. Have a great weekend. Craig Hodges
My pleasure.
with Hodges Capital Management. To read more about his stock picks, head to our website, nbr.com.
And coming up, retailers look for a better fit to cut costs.
I'm Courtney Reagan in Indianapolis, Indiana, and a warehouse full of returned and liquidated merchandise. I'll tell you why returns are becoming a bigger problem in retail. That's coming up on Nightly Business Report.
Here's a look at what to watch for on Monday. The National Retail Federation hosts its annual conference. The health of the retail sector will be quite in focus after this week's dim forecast from Macy's. The bankruptcy auction for Sears assets will take place, and as you know, Chairman Eddie Lampert submitted a revised $5 billion bid. At the Detroit Auto Show, the major automakers will show off their vehicles of the future, and that's what to watch for on Monday.
Consumer prices dropped for the first time in 9 months. The decline was due in part to a drop in gasoline prices. Overall, the consumer price index dipped by 0.1%, which was in line with economists' expectations. The report also showed that healthcare and rental costs rose steadily.
Well, the holidays may be over, but gift returns are in full swing, creating headaches for the companies who have to sort through them. The process is so arduous and costly that many of those items don't even make it back to the store shelves. And that's why some companies are getting creative when it comes to managing returns. Courtney Reagan is in Indianapolis.
It's that time of year again, return season. During and after the holidays, returns spike from all those unwanted gifts. But it's a growing issue for retail beyond the holiday season.
The general in-store return rate you see in the 7 to 8% range, while e-commerce is in the 20 to 30% range. So the growth of e-commerce with its extra high return rates are causing overall returns to continue to grow.
An estimated $380 billion worth of merchandise was returned last year, an amount that could grow to $1 trillion in several years. Gartner Research estimates less than half of returned goods end up resold at full price. The rest gets refurbished, liquidated for pennies on the dollar, donated, or thrown away.
Many retailers end up throwing away over 25% of their returns. And holistically, that ends up being over 5 billion pounds of goods that end up in landfills.
Some of the nation's largest retailers are losing hundreds of millions of dollars a year on returns. But there are companies that can help retailers to lower the cost.
B-Stock builds online auction B2B marketplaces for each client, and we drive buyer demand, and the buyers are businesses in these marketplaces, and it creates competition. So the businesses are competing against each other for the inventory, and ultimately it sells for the highest price that the market's willing to bear.
This is just some of the merchandise that's currently up for auction on the online marketplaces that B-Stock builds for retailers like Walmart, Amazon, Best Buy, Macy's, and others. The volume of returned or liquidated merchandise moving through B-Stock auctions is up nearly 100% over the last year. Target, Under Armour, Jet, and others use Optoro's software to determine which method, restocking, refurbishing, liquidating, or donating, will generate the highest sales price. Optoro says its platform increases a retailer's recovery by an average of 25%. Over the last several years, Best Buy has focused on selling open box returned goods online and during promotions to help manage return costs. Amazon says it works hard to reduce the amount that goes to liquidation and inspects returns, reselling only what it ensures is a quality product. While there are new ways to manage returns, it may not be enough to keep up with the volume coming back. For Nightly Business Report, I'm Courtney Reagan in Indianapolis.
And before we go, a flat day on Wall Street if you just joined us, but for the week, the major averages were higher, up more than 2%.
That's Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a wonderful weekend.
Yep.
See you on Monday. You too.